Meditators, today I'm going to talk about market cycles in another solo episode. This is going to be the key to maximizing your returns in a bull market. I'm going to share how to spot what stage of the market we're currently in, how to position yourself according to market conditions, and how to take advantage of the money flow cycle in crypto. Understanding market cycles is essential for anyone looking to be profitable in crypto, and given the recent price movements, I really wanted to record an episode on the topic. For improved audio quality, remember to like and subscribe below. To stay one with the crypto markets, sign up and get 6 free market meditations newsletters a week. You'll find a link in the description below. A quick thanks to our partners Exodus for making this podcast possible. There will be more on them later. The crypto market is highly cyclical, just like all other financial markets. Getting to grips with the macro environment of the market will help give context to any price movements and therefore allow you to make more informed trading and investing decisions, increasing your profitability. Here are my thoughts on market cycles. Let's start by prefacing this with the fact that there are no certainties in the market, only tendencies. And therefore, when analyzing the market, we will only be able to achieve an assessment of what is likely going to happen, not what is guaranteed. Consider a game. There is a jar with 100 balls, some of which are white, some of which are black, and you have to guess which ball will be drawn next. If you don't know anything about the contents of the jar, betting on which color you will draw would merely be an uninformed speculation. If you happen to know that there were 70 black balls and 30 white balls, whilst you still cannot be certain of what colour will be picked next, you would be able to win more often than you would lose, should you pick the right colour. There does not have to be any certainty in order for the game to be worth playing. If you have a knowledge advantage by understanding tendencies in the market, or the number of white balls in the jar in this instance, you will be able to win more often than you lose and be a profitable trader. This analogy also really makes it easy to understand why making a profitable trade isn't what makes you win. Because if you were to pick a white ball, of which there is only a 30% chance of it being drawn, and you made money off of that, that's a loss, because if you continued to make this decision for the rest of your life, you wouldn't become a profitable trader. So it's very important to disassociate being right with being a profitable trader. Understanding market cycles allows us to gain a knowledge advantage by revealing some of the tendencies of the crypto market. Events in the cycle shouldn't be viewed merely as each being followed by the next, but much more importantly, as each causing the next. Now, this means a cycle oscillates around the so-called secular trend, a midpoint or something that can be viewed as reasonable. For example, the stock market secular trend is rising and is made up of the underlying growth of the businesses and their dividends. These oscillations can be understood as taking place in phases. Phase 1, recovery from an excessively depressed lower extreme or low toward the midpoint. Phase 2, the continued swing past that midpoint towards an upper extreme or high. Phase 3, the attainment of that high. Phase 4, the downward correction from the high back toward the midpoint or the mean. Phase 5, the continuation of the downward movement past the midpoint toward a new low. And phase 6, the reaching of a low. Phase 7, once again, recovering from the low back to the midpoint. And phase 8, again, the continuation of the upward swing past the midpoint towards another high. So this explains the tendencies of a cycle or a market cycle, and understanding it can help us win more often than we lose. Let's dive deeper into spotting which part of the cycle we're currently in right now. There are 2 key steps that can assist in identifying where we are in the market. Are valuations excessive? If there are no deviations from the perceived fair value or secular trend, the market is not excessively high or excessively low. How is the investment community acting? We can then use the actions of the investment community to ascertain if the market is priced above or below fair value. Firstly, consider the market outlook. When valuations are excessively high, the general market sentiment will be positive. Asset holders will have made money and as such can be happy to continue holding their assets or even buy more. When valuations are excessively low, asset holders will be losing money and therefore be rushing to sell their assets so they can stop these losses. Then consider investor qualities. At the top of the market, investors will be aggressive. They will be blinded by the gains they have made or could make and will likely be taking on too much risk. At the bottom, you will see investors practice caution and discipline. They will be emotionally impacted by their losses and will therefore be taking on too little risk. Finally, consider the availability of capital. During times of excessively high valuations, availability of capital will also be high. There will be a large number of lenders, mostly eager to lend to market participants with friendly lending terms. Conversely, during times of excessively low valuations, availability of capital will also be low. There will be few lenders in the market and also lending terms will be restrictive. Now, few of these indicators are directly quantifiable and you will have to use your discretion when basing any decision off of them. To provide some examples of how to use this information, consider the sentiment on, say, social media. Twitter or the Discord groups you're a part of are great for crypto. Do investors believe they are going to make life-changing money, or do they think they're going to lose everything? Look at on-chain analytics, especially inflows and outflows to exchanges and cold wallets to understand whether investors are holding or selling assets. So now we have a better understanding of where we could be in a cycle. How do we understand how to position ourselves to take advantage of the market conditions over the long run? The key here is to remember that the market is cyclical and it tends to oscillate between a secular trend or a midpoint. If you believe the market is excessively low, there is a tendency for a positive outcome when the market moves upwards to revert to that midpoint. One option here is to make your portfolio more aggressive, risk more capital, hold lower market cap companies, and make investments that are highly dependable on good macroeconomics. Now, if you believe the market is excessively high, the opposite is true. There will be a tendency for a negative outcome as the market may move downwards to revert to that midpoint. If this is the case, you may want to adopt a defensive portfolio. Opt for more stable assets such as stablecoins, diversify your portfolio to protect against downside risk, and buy more established assets that have less volatile market cycles. There are often ways to capitalize from a bull market even whilst holding stable assets. Right now, there is a large demand for stablecoins in the crypto market to fuel the bull market. This demand has made it possible to earn high yields on these stablecoins whilst taking on a lot less risk than taking aggressive altcoin or Bitcoin positions. One of the biggest problems in the crypto industry right now is that there are far too many applications and none of them are very user-friendly for beginners. That's why we've partnered with Exodus. They're a desktop and mobile wallet that allow users to own their own private keys, navigate a very easy interface where they can view their portfolio, store multiple different cryptocurrencies, as well as exchange and earn interest on those cryptocurrencies. So if you're interested in checking them out, head over to exodus.com. That's EXODUS.com. In addition to macro market conditions, money flows in crypto tend to follow a cyclical nature. Put simply, money often flows from Bitcoin to large caps, to mid caps, to low caps. As traders in Bitcoin see the price rise and their profits increase, naturally they begin to ask the question, where can I roll my profits into next? Similarly, external participants will feel like they've missed the boat on Bitcoin and look for the next best thing. As the Bitcoin price continues increasing, traders begin rotating out of Bitcoin into other large caps like Ethereum that haven't pumped quite as hard yet. This cycle repeats as the capital rotates out of assets that have pumped into assets that haven't pumped until the capital eventually pours back into Bitcoin. Given the previous example, you can see a trader may sell from Bitcoin to Ethereum, and then once Ethereum feels like it's done, they may go to, say, Solana next, and then sell Solana for one of the many small caps available before repeating the process again and ending up back in Bitcoin. So how do you know what stage of the rotation we are currently in crypto specifically? One of my favorite things to do is to watch the ETH-BTC pair. When Ethereum outperforms Bitcoin, it is a sign that mid caps and low caps often will follow shortly after, as traders roll their profits on away from Ethereum into lower cap coins. A bullish technical altcoin setup for a mid cap or a small cap is more likely to break upwards when Ethereum is also bullish against Bitcoin. The next thing you can look at is Bitcoin dominance. When Bitcoin dominance is bullish, it is a sign investors and traders are deploying their capital into Bitcoin. When Bitcoin dominance drops, this is a sign that capital is flowing into other coins. But also remember, just because ETH-BTC is bullish and Bitcoin dominance is dropping, altcoins are not guaranteed to pump. As traders, our job is not to predict what the market will do next, but utilize our data to get positive expected value and take high probability setups. However, even with all of these tools at our disposal, remember that it's difficult to ever catch the true top or bottom of these cycles, and it can be quite tricky to rotate from one to another. If you sell Bitcoin too early, you may miss out on a parabolic move upwards, whilst your alts hold USD value but drop drastically in BTC value. Sell Bitcoin too late, and now the altcoin you planned to long is already up 50% and throwing off your trading opportunity. To overcome this, remember, you don't need to trade these cycles with your entire portfolio. You can hold spot Bitcoin as a long-term investment that you never rotate anywhere. This can ease the psychological setback of rotating into altcoins too early, as you're still profiting off of the Bitcoin rise with your long-term stack. Secondly, you can scale in and out of these positions slowly. Instead of rotating all of your Bitcoin into altcoins at once, consider rotating incrementally. Another key consideration is when you do rotate out of Bitcoin into large caps or mid caps, you can diversify your rotation. Given that altcoins are less liquid than Bitcoin, big money can manipulate them relatively easily. Especially the mid caps and small caps can be moved with even the smallest sums of money. Thus, trading altcoins is a lot more risky. So as you begin rotating out of Bitcoin into large caps, small caps, medium caps, you may decide to rotate into a selection of altcoins rather than just picking one. You can also adjust your position size based on the risk of the particular altcoin you're playing. Additionally, you may think to rotate a percentage of your Bitcoin profits into stablecoins so you have purchasing power in the event of a Bitcoin or altcoin correction. Now, the last key point to mention when thinking about trading market cycles is to trade with the market. Whilst technical analysis is critical to develop your effective altcoin trading plan, not even the most bullish, technically sound altcoin setup is likely to break up if Bitcoin begins dropping aggressively. Trade with the trend of the overall market, and this will help avoid losing money during periods of uncertainty. To conclude this episode, understanding market cycles is absolutely essential when it comes to making profits through trading and investing. Remember, review investor behavior, such as market outlook, investor qualities, and availability of capital to help ascertain whether valuations are excessively high or excessively low. Position yourself for a long-term reversion to a secular trend or midpoint. Always consider the crypto cycle flow from Bitcoin to large caps, to mid caps, to low caps, and make sure to use the ETH-BTC pair as well as Bitcoin dominance to help understand probable outcomes. And always trade with the overarching market trend. Market cycles will dictate your trading and investing, whether in crypto, stocks, or any other asset. To help understand the macro picture, I can keep you up to date with my team of researchers 6 times a week for free. This is with my newsletter, which you can find at KoroushAK.substack.com. Whilst all markets are cyclical, few of them are as volatile as crypto. Because of this, there is a large amount of money to be made, but there is also a large amount of money to be lost. To understand more about dealing with volatility, check out my episode, How to Survive Volatile Markets.